ULTY is down 7.5% in the past 5 days. What is the problem exactly with ULTY? That is what a lot of people are wondering, and what exactly is going to happen for the future of ULTY. In this video, we're going to be going over ULTY ETF, why it's down, and what you have to understand about this ETF before you even invest in it. So ULTY is, of course, YieldMax's little baby. It's the YieldMax Ultra Option Income Strategy ETF. It used to be very popular during the bull rally since April, but we can see the stock price has declined significantly. It's down 18.5% in the past month, and we can see it's down from its July highs of $6.40. So a lot of people ended up investing in ULTY during this May, June, July timeframe. So they're actually down quite a bit money on the share price alone. Now, factoring in the distributions, of course, that helps mitigate the loss. I know I'm pretty much right at the break-even point, even though we had this significant decline, because I've been holding ULTY for quite a while now and collecting weekly distributions. But there are some concerning things with this ETF. It's definitely a high risk ETF. And why exactly is this ETF declining? Well, first of all, this ETF is working as it's intended. You are getting that weekly income. You are getting a quote unquote diversified portfolio. It holds 15 to 30 stocks. Now, the problem with that point right there is the diversification point. Even though it's not a single stock ETF, it is going to invest in very highly speculative, volatile companies. We take a look at the top holdings, we can see we have companies such as Robinhood Markets, Rocket Lab, Coinbase. We have some other companies I don't even know the names of, Iran Limited, Rigetti Computing. So we have smaller companies, very speculative companies, of course, because the more volatile, the more speculative the companies are in the holdings, it means you're going to get a higher premium for that weekly income. And we can see a lot of these companies are pretty much companies that I personally wouldn't even buy individually myself. Now, you have to take a look at the holdings. That is the main thing with this ETF, because if you don't agree with the holdings, you don't even know what these companies are, you shouldn't even buy this ETF, because you have to be bullish on the underlyings in order for this ETF to do well. And in the past month, a lot of these companies have been dropping in price, and that is the main reason why this ETF has been declining. It's not really necessarily the underlying strategy that they're using with this ETF, it's the holdings they are choosing, which have not been great. Now, they have been great. April all the way to July, they've been picking holdings like Robinhood Markets, Coinbase, which have skyrocketed in price. But because it's using that covered call ETF strategy, you are going to be limiting your upside. So we've only seen the ETF price go from about $5 per share all the way to $6, mid $6 in share price appreciation, which has led a lot of people to buy other ETFs such as Brown Hill's WPAY, which, even though it is on a decline in the past week, we have seen the upside potential with this ETF as it does actually rally in bull markets. Now, of course, with any ETF, there is risk involved, and that is something that a lot of investors have to consider. Like, if you are a long-term investor, you want to see these dips as a buying opportunity, as long as you believe in the underlyings. Now, comparing ULTY to WPAY in terms of holdings, WPAY has much better holdings. We're seeing not many meme companies, speculative stocks. We're seeing big tech companies like Amazon, Google, Apple, AMD, Nvidia. So these are all well-known companies. Most of them are in the S&P 500. They're actually going to be adding gold to this ETF as well. So there's going to be some pretty decent diversification. It's, in my opinion, going to perform better over the long run. And even though it's not going to pay consistent distributions, we can see it's ranging all over the place from 51 cents per share all the way up to 85 cents per share. It is going to have upside capture that a lot of people have been missing out with ULTY. But if we take a look at the distributions of ULTY, a lot of the reasons why people were staying in this ETF was because of the consistent distributions week over week. We can see ever since March, it's been paying about 9 cents, 10 cents, sometimes 8 cents per share very consistently. And we saw all the way since August, late August, 9 cents per share all the way up till the end of October, which it dropped to 8 cents. And then we've had its lowest distribution yet, 7 cents per share for the first week of November. Now that is going to be still paying about an 80% distribution rate, but that's because it's basing it off of this $5.50 price point. Yes, a lot of people are not very happy with this ETF. And of course, if it doesn't align with your goals or strategy, definitely transition into a different product because you're not really married to these ETFs. They are actively managed. You are getting killed on it in a high expense ratio. So you definitely want to put and move your money where you feel best fits your goals and personal risk tolerance. So yeah, that is the main reason why ULTY is dropping. It's definitely the underlying holdings which have dropped in price over the past month. So with any of these ETFs, you want to make sure you check out the holdings, make sure you're bullish on them or at least neutral, because otherwise you're not going to be very happy with those ETFs if they end up dropping in price. And then of course you have to understand the underlying strategy. With ULTY, those cover call options are going to limit your upside capture. So if you want something that has a little bit more NAV stability, you want something that grows in price over time, but possibly over the long run, then you definitely want to kind of avoid these extreme covered call high yield income strategies where it's maximizing the yield, but not really prioritizing the long-term growth of the ETF. Now with WPAY, it is 1.2 times leverage, so it is going to be a little bit more risky. We've seen this ETF drop in price 13% in the past month, so a pretty huge dip, but the whole overall market has been dipping with it. But as long as you're bullish on the underlyings, which is going to be a lot of these big tech companies, then in my opinion, it's going to be a good one in the long term. And a lot of people are falling in love with WPAY. It has $500 million assets under management now because we saw in the first month of this ETF trading going from about $50 per share all the way to the high of $56 per share. There is room for upside growth with the bull rallies that these companies have been experiencing September to October. But we definitely want to compare all of the options that we have available to us, especially the weekly income. Now, WPAY doesn't really compare to ULTY. One person in the comments of one of my other videos have pointed that out, which is a good point, but a lot of people have been doing that transition from ULTY to WPAY. And in fact, the competitor to WPAY would actually be YMAX because they're both fund of fund option ETFs. YMAX is going to include every single stock ETF available that YieldMax has. And if you've been watching my channel for a long time now, you know I'm not a huge fan of the single stock ETFs. I do think there's a ton of risk involved. Now, of course, if you have that high risk tolerance, definitely choose those products if you want. But for me, I like to have at least multiple stocks or holdings inside my ETFs so I have a diverse portfolio. And YMAX is going to have at least 50 ETFs that are available to the YieldMax ETF lineup. But not many people talk about YMAX. I do hold YMAX. It has been consistent, even though we're going to have this decline in price over time. I do collect those weekly distributions. We can see the yield is somewhere around 75%. It's been paying out quite consistently, and I enjoy this ETF, even though a lot of people don't talk about it. And while it might not be the most exciting, it is definitely a good alternative to TY if you want that. But it is doing those covered call options, so you are going to limit your upside. And that is why a lot of people are a fan of WPAY and some other of these newer products that are coming out. Now, some other ETF issuers have released their own products. RexShares has released their new ETF, ticker symbol ULTI, which is going to be the Income Max Option Strategy ETF, pretty much mimicking what ULTY was, picking volatile stocks in order to maximize premium, as well as using a hedging strategy to prevent any extreme downsides. Now, a lot of people get that a little bit confused, the hedging part. A lot of people thought ULTY was safe because it had protected puts. Now, it's only going to protect you during extreme downturns. Say the entire market drops 50% in a single day. You're not going to see that entire loss with ULTY because of those protected puts, but you are going to see a significant decline in price, just not as bad as when it dropped. And you are also going to be eating into some of the premium during bull markets because you have to pay for those puts. That is just the trade-off of that strategy. Now, I'm a huge fan of that strategy. I do think having some insurance is definitely needed for using volatile stocks like that. But for a lot of people, they don't like how it eats into the premium. And in slow declines, you're still going to experience that loss. Now, another ETF to consider is one by Curve releasing their own competitor to ULTY. All of these ETF issuers are trying to steal the market share from YieldMax. YieldMax is definitely not happy about this at all because they're going to be losing some of their market share and they're not going to make as much money from those expense ratios. Now you can see KYLD is Curve's high income ETF. It's been trading for a few days now and it has this crazy spike to $27 in after hours. But it has been down 8-9%, and it is going to be a rival to ULTY also. It pays out weekly distributions, going to have a high expense ratio of 1%, which is not normal, which is not unusual for actively managed ETFs. It's just something that comes with actively trading because we do have to pay the fund managers for trading options every single day. That's the main reason why we're buying these option income ETFs in the first place. We don't want to spend the time to do it ourselves, but we do have to watch them, see how it's performing every now and then in case we want to pull out and buy something else. But definitely let me know in the comments down below what your thoughts are on ULTY. Are you still holding? Are you selling? A lot of people are thinking that it's a buying opportunity, seeing this ETF down so much, but the number one thing, in my opinion, take a look at the holdings, see what they're holding, and if you're not bullish on any of these companies, definitely consider not even selecting this ETF because you have to be bullish on these underlyings in order for this ETF to perform well.